It's been a really volatile last 6 months, actually, when you look back to October when the equity markets had a big drawdown quickly, following into November and December with what happened in the oil price and more recently in the currency space. There's been volatility all over the place, but as active managers, we really take advantage of that to create value for clients over time. I would say the biggest driver for the oil price to where we are now, below $60, was the change in stance from OPEC. The fall in the price of oil has a significant impact, not just for the oil companies themselves, but our country here in Canada and the Canadian dollar. Obviously, the Bank of Canada recently reacted by cutting rates, something that few expected, due to the potential negative impact of the oil price decline. I actually think one of the biggest risks out there going forward is going to be the volatility in the currency markets, not just the change in stance in the US and Europe, but what potentially some other countries like China might have to do to protect their own economies. As active managers, it's very important for us to differentiate ourselves from the benchmark. We do have a problem in Canada where the benchmark is significantly concentrated in two areas, financials and commodities. We feel that it's very important to open our clients up to other sectors of the economy, both in Canada and outside, by picking value-creating businesses outside of those areas. And at this point in time, the equity market's not giving you the best opportunities that it did maybe 2 or 3 years ago. And that's why active share is so important at this point in time. You have to look into the market to find where the lowest risk profile is and try to find those incremental returns without having to take on cyclical or valuation risk. Active management is very key to our philosophy. By hiding in the index or replicating an index, we're really not earning our pay. We're professional investors. We look at from the bottoms up and we try to build portfolios organically that at the end of the day will not look like the index. A consistent philosophy that we have across the products we run at Cambridge Global Asset Management has 3 facets. Number 1, high active share. Number 2, a focus on downside risk, understanding that value-creating companies will add value for shareholders over time, and it's our job to make sure we're not overpaying for those assets. And the final thing is that we have significant shareholder ownership ourselves. Those 3 things combined, we believe, can deliver better performance over time, not just absolute numbers, but better quality of performance.